Hello friends, my name is Beroz and welcome to my channel where we talk about how you can live your best life and be your best version. Now in this video, I will share with you the approach I make use of in order to outperform the average market returns for my stock investments. Now first and foremost, let me agree to the idea that on any normal day, it is impossible to outperform the average market returns for an average investor like me. This is primarily because of two reasons. Firstly, I'm not a professional investor. I have a day job, I have a family, I have hobbies, and I don't have time to go into the details of financial statements of a particular company, how have they performed historically, what are their future plans, how their management is taking care of the company, and all the nuances that come with it. Secondly, it is due to the efficient market hypothesis, which argues that the assets are correctly priced because they reflect all the information out there that is available to the investors in the price itself, hence giving rise to the understanding and belief that it is impossible to outperform the market, especially because I will at any given point in time not have any special or unique information that is not available in the market, basis which I can make an investment which will significantly outperform the market. However, there is still hope for someone like me who invests passively but can still outperform the market. Now let me explain you why and how. While efficient market theory is a very strong and powerful concept, however, there still exists a great and big difference between academic theory and real world practice. Markets are prone to mood swings as people are crazy and emotional. They buy and sell things in an emotional way and not a logical way, and this is what makes the markets inefficient. And this is exactly where the opportunity lies for all of us to benefit from. Now let me explain this more by sharing a story. There was once a professor and a student who were taking a walk in the campus. The student found a $5 bill on the pathway, and he pointed out to the professor that, see, there is a $5 bill. And the professor said, no, it can't be a $5 bill, because if it was a $5 bill, someone would have already picked it up. The professor walks away. The student picks up the $5 bill and gets himself a drink. Just like that student, I look for those rare opportunities when everyone is looking away from that $5 bill, either because of fear or because of following a herd mentality. This is also true for master investors out there like Buffett and Munger, who detach themselves from the madness and watch dispassionately until the bipolar market provides them with what Munger calls a mispriced gamble. Investing is mostly a matter of waiting for these moments where the odds of making money vastly outweighs the odds of losing money. As Buffett says, you don't have to swing at everything. Rather, you can wait for the pitch that is right for you. Now let me share with you how I put this understanding into practice. While I propose and follow dollar average investing approach, which I have also laid down in detail in the video with the link above, the method, as I've previously explained in the video, while it's highly reliable and suitable for 90% of investors out there, however, it will only deliver you average market returns and will never outperform the market. Using dollar average investing approach, I invest on weekly basis a fixed amount in an S&P low cost index. Now this is where things start to get interesting, because I have an overlay of a second approach that I use hand in hand with dollar average investing approach, whereby every time the market dips between 10 to 20%, which has happened around 29 times since 1946, which is around every 2.5 years, I would pull forward 3 to 6 months of future investment installments and invest them in the dip over the period of 1 to 2 weeks. I see this as a major opportunity to buy in the dip and hence accelerate my returns over and above the average market returns. Now, in case the market dips 20 to 40%, which has happened 9 times since 1946, which is approximately every 8 to 9 years, I pull forward 6 to 9 months of future investment installments in order to buy into the dip over the period of 3 to 4 weeks. And in case the dip is more than 40%, which has happened once in 26 years, I would pull forward 9 to 12 months of future investment installments in order to invest them in the dip over a period of 4 to 6 weeks. These sudden dips are best times when the market is inefficient, and even best for those who are sitting during this time on cash. And this has exactly been my case, because I don't go ahead and invest all the cash that I have in the market at any one given point in time. And because I distribute my investments in small chunks over a long period of time, I'm always sitting with some amount of cash on hand. And it is exactly these opportunities which allow me to make use of that cash and double down on my investments and buy into the dip. Assuming in next 20 years, the market returns an average return of 10%. Now, with using the approach of aggressively investing during the dip of 10 to 20%, one can easily outperform the market by 3 to 5 percentage points, which in dollar terms means, let's say for an example, if you're investing $2,000 every month for 20 years, you can earn extra $1 million versus the base scenario where you're only earning average market returns. Now, watch out. While I'm talking about the market as a whole, there might be opportunities on a single stock when a single stock dips by 10, 20, 30 or 40%. However, I strongly advise against trying to outperform the market by picking a single stock. Because despite the dip witnessed by that single stock, it may still be an overpriced stock, which you may just end up buying out of fear of missing out. Now, the example that comes to my mind is the darling stock Yahoo, which was trading at $120 during its peak in 2000. And within matter of days, it slipped down to $8 per stock and never recovered again. Hence, I maintain a strong recommendation to invest in point in time when the entire market is inefficient due to a significant dip. This way, when you invest in the market, you are getting a cheap bargain, which is also diversified. Hopefully, this approach will now help you grow your investments further and outperform the average market returns.